Hello everyone, welcome to MastersTeach, and today we'll discuss about the financial management. In this, we'll discuss concepts, decisions, analysis and problem solving. So we'll cover all the 5 units, okay? So from financial planning, dividend theories and different types of questions so that it will be easy for you. Let us start with the session. Okay, what is financial management? Okay, financial management means planning, organizing and directing and control of financial activities of a firm in order to achieve objective efficiently. So the financial management includes concepts and theories of finance, techniques of financial management, functions of financial manager, and importance in decision making. So there are three major financial decisions. One is financial decision. So in what is that financial decision means? How to raise the funds, whether through IPO, whether through borrowing, whether through taking the loans. So how to raise the funds, that is financial decision. And once you raise the amount, where to invest, okay, where to invest that particular amount. And once the company is grown, one has to give the profit to the shareholders. So how to distribute the profit and through dividends. So all these comes under financial management. Okay, it is planning, it is organizing, it is directing and controlling the financial activities of a firm or a company or a factory in order to achieve its objective efficiently. Okay, this is the thing. Let us go to the next slide. Introduction to financial management. So the concept and scope, it covers the procurement, means how to raise the funds and how to utilize and how to control the funds across all the business activity. So this is a simple planning. Then what is the functions of financial management? Okay, it is like financial planning, financial capital budgeting, managing working capital and raising funds. So what is the role of financial manager? So you have to analyze the various investment options. So manage the risk, ensure that there is a sufficient liquidity and maximize the firm's value. So what is the importance? So it supports the decision making and ensure that solvency and drives for long-term growth. So when they are asking the examination, what is the financial management? So you have to write concept and scope. Okay, so concept, what is the concept? It is like cover the procurement, means collection of the funds, utilization of the funds and control of the funds for all the business activities. So what is the functions? It is the financial planning, capital budgeting, managing working capital and raising funds. So what is the role of a financial manager? Analyze the investment decisions, manage the risk, ensure that the liquidity should be maximize firm's value. The importance. So why it is important? In order to make the decisions. So in order to avoid the insolvency, ensure that there is a solvency, and it is for the long-term growth of a company. That is the reason we need to have financial management. Let us go to the next slide. So here, profit maximization versus wealth maximization. So here is the objective. So what is the objective of profit maximization? So maximize accounting profit And wealth maximization means shareholders' wealth can be maximized through EPS, that is the equity per share or share price. Then time horizon. So profit maximization, it is a short term focus, whereas wealth maximization, it is a long term focus. So in profit maximization, it ignores the risk, whereas wealth maximization, it considers the risk and uncertain. So the time is not considered in profit maximization, whereas in wealth maximization it is considered. So profit maximization is the traditional view, whereas wealth maximization is the modern and accepted approach. So always remember, many times it is asked in your examination, try to remember the same. Then let us go to the next slide. So here, financial planning, time, value of money. What is financial planning? Planning, that is you're going to estimate future financial requirement, how much amount is required, how much finance is required, and you have to arrange funds accordingly. That is a financial planning. So, and what is included in financial planning? Ensure that there is availability of sufficient funds at the right time, and the financial planning can be short term or long term planning. So the factors include, okay, in financial planning, what is the factors include? You have to forecast the sales, how much sales can be happen, and according to the sales and according to the like, you have to estimate the production plan and cost structure also. This is the about the financial planning. Okay, so the value of the money is today is not going to be the same as tomorrow. For example, today is 1 rupee, tomorrow is more than 1 rupee. So due to earning capacity as well as due to inflation. So here the future value equal to, that is FV, that is future value is equal to PV, that is a present value into 1 plus or n. So this is the future value FV, whereas present value, so present value means PV equal to FV plus 1 plus or n. So this is about the discounting, bringing the future sum today. So this is about the financial planning and time value of money. Okay, here the R is interest rate, whereas N equal to number of years. You have to remember, this is the thing. Then we'll go to the financial decision and capital structure. What is financial decision? So it is a mix of debt and equity, so to finance business assets. So what is the capital structure? So capital structure is the debt versus equity of total capital. So there should be a balance between equity as well as debt. Equity is the own amount, whereas the debt is borrowed funds. So what factors influence the capital structure? So one is the cost of capital and financial risk, and which type of business you are doing, and cash flow. Then control consideration, market conditions and tax benefit. So let us see what is equity and debt. It's a total firm's finance. So equity is including equity shares, then retained earnings and preference shares, whereas debt is equal to debentures, terms loans, bonds. So the mixture of equity plus debt, it becomes total capital of the firm. This is the finance decisions and capital structure. So financial decision, how it is happen? So on the basis of the cost of capital acquired, financial risk, nature of business, cash flow, control consideration, market conditions and tax benefits. This is the thing. Then let us go to the next slide. So cost of capital. What is the cost of capital? It is a minimum rate of return a firm must earn to satisfy in its investor. What is the cost of capital? If you are running the business, at least you have to earn the minimum return what you invest, so that the investors will satisfy. That is the cost of capital. So this is the formula, cost of debt, that is KD equal to LI plus I into 1 minus T divided by NP. I is the interest, T for tax, NP means net proceed. Then cost of liquidity we represented as KE, D1 divided by PO plus G. D1 is a dividend, PO is a market value, and G is the growth rate. So remember these formulas. Okay. Then weighted average cost of capital. It is a overall cost. So it is a cost of debt and cost of equity. So both become one, that is called as weighted average cost of capital. Overall capital equal to weighted average of all source of finance. So this is the thing. Let us go to the next slide. So capital structure and theories. So how the capital structure is there and what is the different theories. So the theories we have NI approach, that is a net income approach. Then NOI approach, that is a net operating income. Then traditional approach. Then approach, that is a Mudglini Miller. So what is NI approach, net income approach? So more debt, so that lower cost of capital. So effect on the firm, if the debt will be increased, firm value increases with the debt. And net operating income approach, that is a capital structure is irrelevant. Okay, as the firm's value remain constant, whereas traditional approach, so it is optimal capital structures exist, whereas value maximized at optimal mix. Then approach, it is a Modigliani and Miller, so no taxes, value unaffected by structure, those the firm value independent of finance. So this is about the capital structure theory. Then leverage of EBIT and EPS analysis. So types of leverages, EBIT, so earning before interest and tax, that is a EBIT, that is a earning before interest and tax. EBT is equal to earning before tax. EPS means earning per share. So how this EBIT, that is the earning before interest and minus EPS, earning per share. So how it can be solved? Compare the EPS under different finance plans at varying EBIT level. So if EBIT is 1 lakh, then interest is 20,000, the tax is 30%, so shares 10,000. So EBT, this is a formula, just go through the same. Then operating leverages. Operating leverage means contributing plus EBIT. What is EBIT? Earning before interest rate. So which ensure that there is a impact of fixed cost on operating profit. Then financial leverage. Financial leverage equal to EBIT, earning before tax and interest and tax, plus EBT, earning before tax, which measures the impact of debt interest on earning per share. This is a leverages EBIT EPS analysis. Let us go to the next slide. Okay, investment decisions and capital budgeting. So what is investment decision? So deciding where to invest and long-term funds to generate maximum returns. So this investment decisions also called as capital budgeting decisions, so which involves like large irreversible commitments, then affects the firm's future profitability and risk. So the importance of investment decisions and capital budgeting is that which has a long-term impact on firm value. It requires careful cash flow estimation. It involves risk and uncertainty. This is a importance. So the investment decisions and capital budgeting. Let us see the mind map. This is investment proposal. So which says about the project and its object, and estimate cash flow. So it estimate the project future inflow and outflow of the cash. Then evaluate techniques, so using NPV, IRR, payback methods. Then accept or reject, so compare the result to decision criteria. Then implement on commit funds and monitor progress. So this is about the investment decisions and capital budgeting. So let us go to the next slide. Capital budgeting and techniques. So these are the capital budgeting methods. These are types, and this is a formula and decision making. Payback period. It is a traditional type of capital budgeting. So initial investment plus annual cash flow. It is a short term and better. Whereas ARR, accounting rate of return. It is a traditional method. So average net income divided by average investment into 100. So the decision is higher and equal to better. NPV. It is NPV equal to DCF, that is a discount cash flow. The PV of inflow minus initial investment. NPV greater than 0 are accepted. IRR, that is a rate of return, initial rate of return. It is a DCF, that is a discount cash flow, and rate of which NPV is equal to 0. IRR greater than cost of capital, it is accept. PI, okay, it is a profitability index. So it is a type of DCF, is a discounted cash flow. Then formula is PV of inflow divided by initial investment. So P1 greater than 1 is accepted. This is about the capital budgeting techniques. Then let us go to the next slide. So risk analysis and capital budgeting. Risk analysis and capital budgeting. Here the risk return. Okay. Here invest, proceed with the project. High demand and low demand, do not invest. Okay. So here the risk and return. Variability is expected cash flows. Higher risk demands higher return. So probability distribution. So assign the probability to possible outcome. Calculate the expected value and standard deviation. Then sensitivity analysis. So change one variable, sales cost at a time, and observe impact on NPV. Then decision tree approach. Map all the possible outcomes and decision in a tree diagram. So calculate expected NPV at each node. Let us go to the next slide. Okay, working capital concept and components. So working capital means, so it is a funds required in order to do the business operations. So gross working capital is called total working capital. So here the working capital is what is a net working capital? Current assets minus current liabilities. So it is a components of current assets. So cash, inventory, receivable, short-term investment. Whereas current liability is equal creditors, short-term loans, outstanding expenses. This is about the working capital. And what is the component of working capital? So it is the current assets and current liabilities. Then let us go to the next slide. Here already discussed about the working capital, and working capital why we require in order to run the business operations. Then working capital determinants and forecasting. So factors affecting working capital. So nature and size of the business, length of the operating cycle, production and policy and seasonability, credit policy, that is the debtors and creators, then a rate of business growth. So forecasting of the working capital. So like they may ask about the estimate current assets, raw material stock, work in progress, finished goods and debtors and cash, and estimate the liabilities like creditors, outstanding ways and etc. So what is net working capital? Current assets minus current liabilities. So you have to remember. Then management of inventory, receivable and cash. So inventory management means holding minimum holding cost, avoid the over stock outs, avoid the excess stock out. Then the key tools are EQQ, ABC analysis and reorder level. Then receivable management, so optimize credit sales and minimize bad debts. Then the tools are credit policy, debtors turnover ratio, etc. Cash management, so maintain the adequate liquid cash, avoid the idle cash. Then what is the tools? So cash budgeting, motive for holding cash. The key balance here: too much working capital equal to idle funds, there is a low profitability. Too little, that means liquidity risk. Optimal management is essential, that is the thing. Then let us go to the next slide. Financing and current asset. Okay, so this theory only topic, no numerical problems is required. Cooperative approach, so finance all assets. There is a fixed plus current asset with the long term funds, so low risk, high cost, high liquidity. Whereas aggressive approach, so finance even permanent current assets with the short term funds, high risk and low cost, low liquidity. Then hedging matching approach, so match the maturity of funds with the life of assets finance and balance finance cost. So this is the thing what you have to remember: higher liquidity equal to lower risk but lower probability. Then a trade-off must be managed carefully. Okay, then dividend decisions, how the dividend decisions can be taken. So the decision how much profit to distribute as a dividend versus return for reinvestment. Types of dividend: cash dividend, stock dividend and interim dividend. So cash dividend is the most form of dividend, the cash will be given to the shareholders. There is stock dividend, the bonus shares will be issued instead of cash. Whereas interim dividend, so before ending the financial year they are going to give the dividend, that is the interim dividend. So the what is the factors influence the dividend? So like in order to they want to retain the profit or pay the dividend, that is the main factors influence the dividend. Then types of dividend: cash dividend, then as I said bonus, interim dividend. So what is the factors influence the decision? What is the factors influence the dividend decision? Earning stability, cash position, then growth opportunities, then shareholders expectation and legal restriction, tax policy, etc. Then dividend policy. Okay, dividend policy equal to a firm's established approach to deciding how much and how often they have to pay dividend. So stable dividend policy, so they are going to give dividend per share every year. So it is a mature market for the stable companies. Whereas constant payout, so fixed rate of earning paid as a dividend, so it is firms with fluctuating earnings. Then residual dividend policy, dividends paid from leftover profits after the investment needs. It is a high growth firms. No dividend policy, all the profits retained and reinvested. It is for the startup and growth companies. So here the objective is that balance shareholders expectations with the firm's long-term needs that need to be considered. Then here some of the numericals are there. So Walter model relevance, so dividend effect, firm value is equal to P equal to D plus R by KE into E minus D divided by KE. Is a D for dividend, E for EPS, R for IRR, and KE for cost of equity. Then Gordon model, so investor uh, prefer current dividends, P equal to E into 1 minus R divided by KE minus BR. B is retention ratio, BR is the growth rate, K is the cost of equity. Approach, it is irrelevance. Dividend policy does not affect the firm's value in a perfect market. So value depends on earning power and investment policy, not dividend. So what you have to remember, Walter Gordon equal to dividend or relevant, equal to dividends are irrelevant. So you have to assume the same. Then, so what we have learned in the financial management, profit versus wealth maximization, all the stuffs we have covered. Just go through this video again and again and practice all the like examples from your textbook. So thank you for watching. We'll meet with the next lecture. Thank you. All the best.